The coming week. There are two parts to the coming week for all of us to consider. The first part is easily available for all to see and digest. It includes, continued heavy earnings, ISM and factory orders on Monday, which will give us a glimpse into U.S. manufacturing. And this is particularly relevant when stagnation is not out of the question. Additionally, JOLTS on Monday will provide a look at job openings and turnover. The first look at employment comes with ADP on Wednesday, which is, a look at the jobs prior to Friday's employment report. Additionally, on Wednesday will be the, FOMC rate decision, followed by the far more important chairman's press conference. Volatility, by the time we get to Wednesday afternoon, the volatility should have picked up considerably. Finally, the monthly employment report, and a look at possible wage pressures will, be the final day of the week. The second thing that I think is far more relevant is what revolves around April's very narrow range. And you can see that on the monthly bar chart in front of you. On the far right is a very, very narrow range in April, which is very unusual. When I look at the monthly in this narrow of a range, it reminds me of balance. Balance is one of the two most important concepts we deal with. Not only is this a narrow range that resembles balance, and of course our balance trading rules are, go with any breakout from balance, or fade or go against any breakout that fails. But what is more important is the tighter the balance in a whole narrow month of trading, which certainly be defined as a narrow balance, the greater the odds that an exit from that balance will be dynamic. The top of the balance area, or April, is just slightly below the 4,200 level. The recent rally high was at a 1.5 below 4,200, and it was made in the overnight or electronic session. While there's nothing that says that can't be the rally high, my experience over 50 years tells me that there's low odds of that being the final high. What is going on at this level is we've got this standoff. We've got the longer term money that is very complacent, or at least they appear to be complacent, probably more fixed income than they would normally have, and more defensive stocks. They really have not been active in the market, which is one of the reasons that we've seen so little volatility and such low volume. We talk about the pain trade in trading. The pain trade is when the market goes to a level that it will exert the most pain on the greatest number of market participants. If this current rally breaks to the upside, or if May starts to build value above April, that greatly increases the odds of the pain trade. And the pain trade would mean that the longer term money is forced off the side and to commit more to aggressive equities. When the longer term money is underinvested and the market moves against them, it's the same to them as it is to us being short. And the reason being that they are measured on a relative basis, not an actual basis, but a relative basis. If the market goes up and they're not fully invested, they're going to underperform their benchmark. So it is a very questionable market to the upside. Secondly, the market to the downside, the underlying structure below 4,100. And once again, this last week, the market looked slightly below 4,100 and rallied. The market, the underlying structure below 4,100 is exceptionally weak. And I arrive at that by saying there are numerous weak and poor lows. So I don't know what happens this week, but I would think the most important thing is to enter the week with an open mind. Keep your biases aside and be ready to trade with any meaningful breakout relative to April. Have a great week, and we hope there's more volatility and more fun. Thanks.